A $500 billion memory chip market is now worth $4.5 trillion. You're listening to Market Mosaic from Rawazi, the data backed edge for global decision makers. Here's what matters today. First up, the memory chip market has gone through a rapid shift. Just 18 months ago, the combined market value of the world's high bandwidth memory suppliers was around $420 billion. Fast forward to now, and that figure has climbed to $4.53 trillion, a tenfold increase driven almost entirely by demand for AI training and inference. It hasn't been a smooth ride. Earlier this spring, values dropped 23% in just 1 month before rebounding to a fresh high in June, with 70% of the total gain landing in the last 3 months alone. Memory has moved from a commodity component to the tightest bottleneck in the AI supply chain in under 2 years, and producers are still racing to fill years' worth of backlogged orders. If you're budgeting for AI infrastructure, treat memory as a variable cost rather than a fixed line item, not something you can pencil in once and forget. The chips inside your servers today could cost meaningfully more or less by the time you place your next order, and that volatility is now a planning problem, not just a procurement one. Next, let's talk about investment trends. Global greenfield investment announcements dropped 17.5% year over year between March and May 2026. North America was the only region to gain ground, up 4.2% to 1,517 new projects, while every other region declined. Western Europe fell 23.9%. Emerging Europe dropped 34.6% as its regional war entered its fourth year. The Middle East posted the steepest drop of any region, down 67.1% to just 191 projects. Even North America's gain comes with a catch. Its total still sits 1.5% below its 2021 to 2025 average. Capital is consolidating into whichever region investors currently trust most, and that trust is narrowing fast as geopolitical risk spreads. If your growth plan assumes capital flows evenly across markets, this quarter's numbers say otherwise. Anyone scoping expansion should model for concentration, not averages, and build a fallback plan for the regions losing ground. Now let's turn to consumer prices. In June, prices for everyday goods fell 0.4%, the steepest 1 month drop since 2020, pulling annual inflation down to 3.5% from 4.2%. Not every category cooled. Egg, dairy, and bakery prices kept climbing, and lettuce jumped 32% year over year on supply disruptions. The relief may not last. A resumed conflict this week between the US and Iran threatens to push July prices back up before the trend takes hold. A 1 month drop in the headline number doesn't mean pricing pressure is over, especially with a fresh geopolitical shock already unfolding. Anyone planning promotions or margin around a cooling narrative should treat June as one data point, not a trend, and keep a second scenario ready in case July reverses course. One more signal before we go. Retailers are expected to take back nearly $850 billion in returned merchandise in 2025, roughly 15.8% of total sales. Most of that inventory has historically been liquidated at a fraction of retail value the moment it landed back in the warehouse. A growing share of retailers now route it into branded resale channels instead, fetching 45 to 65% of original price versus 10 to 20% in liquidation, and roughly half of those buyers are new to the brand. A return used to be a straight loss. Routed through the right channel, it becomes a customer acquisition tool that pays for itself, turning what was once dead inventory into a second chance at a first impression. That's your Market Mosaic briefing. The full edition, with every chart, link, and source, is at newsletter.rawazi.com. If today's signal sharpened a decision for you, share Market Mosaic with someone on your team. Until next time.